market traps. What is market traps? Now, the reason I wanted to have this training on market traps is because I realized, because someone actually messaged me on Friday, and because last week was a trap week, that's why I didn't personally send out a lot of trades, because I wasn't focused on getting myself into a lot of trading positions. Like when you have a week of traps taking place within the market, you don't want to be in the markets too much. You don't want to spend a lot of your time trading. The reason being is because you're going to end up losing money. You're going to end up basically giving your money away to the markets, and which is the position. Well, that's a position that you really don't want to be in. Like every week, like every month, there's usually a period of time where the market just chops around, gathering and accumulating as much contract as possible before it begins the dominating move. So what we're gonna talk about, myself and the other EM analysts, we're gonna talk about in this training. We're gonna talk about market traps and how you can identify market traps, and even more importantly, how you can avoid market traps as well. So the first thing is, what is a market trap? What is the definition of a market trap? Well, it's very simple. A technical pattern in price movement that incorrectly signals a reversal pattern. This incites traders to commit to a position in anticipation of price movements that does not end up taking place. So this is like what a market trap is, but let me just break this down for you, okay? So the first thing you need to understand is that a technical pattern in price movement that incorrectly signals a reversal in price. So the first thing is that a lot of traders usually get trapped around very strong reversals. So let's say that you're having a very bullish market, so you're having an uptrend in market, and a lot of traders are anticipating for price to reverse. So they're looking for a sell. They're looking for when to sell. Now, what can sometimes happen is that the technical patterns that can show up in the market and indicate that price is about to reverse, okay? Now, a lot of the time, like 80, 90% of the time, it's wrong signals, incorrect signals. So what that does, it incites traders to commit to a position. So it incites traders to either buy or sell, right, at that time, because they are anticipating that a reversal is about to take place. So they're anticipating price movement. But what actually happens is that price movement does not end up taking place. So you end up having price moving in the opposite direction of what you anticipated. That is what a market trap is. And a lot of traders lose money in traps. The reason being is because they get excited and they want to trade the reversals, and it just ends up not reversing. So what is a trap pattern? So there's 3 different trap patterns in the marketplace that are recognizable. And I'm going to actually go on TradingView later on, and I'm going to break down what these trap patterns look like in the real life marketplace. So there's 3 different types. You have your rectangle pattern, you have your flag pattern, and you have your pennant pattern. Okay, so you have your rectangle, which basically is like we have different names for it: consolidation, accumulation, is like arranging markets, like the many different things people call it. Okay, but it looks like a range. Okay, it looks like a market is not going anywhere; it's just going up and down between 2 different regions. And I'm going to actually show you how sometimes this is false support and false resistance that is created to incentivize breakout traders to commit to a position. And then you have flag patterns, and flags and pennants are one of the deadliest traps that exist in the market. And a lot of new traders fall for this all the time. Like all the time, new traders be falling for the flag and pennant patterns. And I'm gonna basically explain the ideology and not just the ideology, but the technicality behind the pennant and the flag pattern, so you guys can understand how to avoid basically getting yourself in positions where you cannot liquidate, you cannot get out of the market in time. And then the next thing I want to talk about is why traps occur. So why do traps actually take place to begin with? Now, what I'm going to do, I'm going to bring up one of our EM analysts, and he is someone he has a very big knowledge of how brokers work and how banks work. If you guys really want to be like, when I say successful, I mean like you want to really get consistent results in trading, you really need to understand the technicalities behind these things and why they happen on the background level. So this individual, his name is Giovanni. He's one of the individuals that I work closely with EM, and he's an incredible trader. And he has a very good understanding of bank levels and brokers and how they operate in order to create these traps to incentivize traders to commit to a move. So I'm just going to bring up Giovanni, and he's going to share a few words. And he's just going to explain to you guys why traps actually occur to begin with. All right, so Giovanni, you're unmuted.
Okay, thank you so much, Walter. Really an amazing introduction of how this trap works. And it's really, really amazing. I can tell you, honestly, I hope that all of you guys have understand what he's talking about, because the things that I'm going to talk to you, I have a really tidy schedule today, so I will use no more than 10 of your minutes, guys. So I want to quick jump on a main point. Basically, guys, as you have see, most of the banks or the institutional trade, institutional banks are using a specific pattern to trap the traders, the retail traders. And
No, Giovanni, your
can you hear
voice,
me?
your microphone is being covered, so your voice is not very clear.
Can you hear me now?
Perfect, perfect.
Okay. So as I said before, basically, guys, most of the institutional banks and the hedge fund are basically trading against the retail trader. How? It's really simple. First of all, I've noticed that since I started to enjoy this market, the financial market 4 years ago, most of the people has no idea how exactly brokers works and institutional banks constantly. So one of the first thing that you need to know is that the institutional banks are open 24 hours to 7. So they are open even Sunday and Saturday when we are not able as a retail trader to trade. One of the main thing is understand how they are making money. They are not just making money from the market in terms of how the market is moving. They are making money through the spread, first of all, so the difference between the bid and the ask. Because as you ever see, guys, sometimes maybe during a specific time of the market, you can see that the spread is a little bit more big, sometimes it's too tight. Depends on which kind of account are you using. The second way how they are making money is the interest. The interest is the swap that you can see from your account most of the time is how they are making money. The third way how they are making money are the commission, basically. And the fourth way are the aging. What exactly are the aging? I think, guys, that I suppose, guys, that you know what are the commissions. So when you open a specific position and you're using a specific lot size, you are paying a commission to your broker. The aging instead is the last one, but the most profitable way how brokers are making money. So what does it mean aging? They are literally keep on a house or your trade, because I don't know if you know, guys, the 90-90-90 rules. The meaning is 90% of the trader lose the money, lose the 90% of them capital in the first 90 days of trading. So based on these rules, do you think that for them is more convenient to give you the DMA, the direct market access, or to keep your trade in the house so they can aging and make money against you twice, basically through spread, interest, commission, and hedging? So it's really simple, the way how the market works. So let's go to another important point that you need to know about how the trading, the financial work, the financial market works is basically they have two kind of main books, the book A and the book B. The book A is the access that they are giving to you to the direct market, to the intrabank. Most of you should know as intrabank, because sometimes you have see, Walter will show to you later on, how if you are using a trading view, And Hoanda, most of the time, is one of the most precise data that we can have it because it's connected with directly with the New York exchange. Sometimes the price that you are seeing is different than the price that the broker is giving to you through your MT4, your web side platform, or C trader platform. Depends on which platform your broker provided to you. So it's really important to you as a trader knowing what exactly they are doing on behalf of you. So when most of the trader, based on the rules of the 90-90-90, they are losing the money on the first 90 days of trading. So where do you think that they're gonna put you? On a book A with the intra bank, so your order will send directly to the intra bank system or to them house. I think so that most of them, and I know for sure because some of my friends are even broker as well, and for open a good brokerage firm are really good. The meaning is under the FCA regulation or the ECA or the regulation from Australia that are the three biggest main financial regulation in the world. You need to put at least 50 millions of loan of money, and you will get as a broker a specific amount of money from the biggest liquidity provider of your own country. What does I mean this one? That if you are in UK and you want to become a broker, you need to put 50 millions on the table, and then you are the choice. You can have the choice. First of all, to having the FCA regulation. Second of all, the biggest liquidity provider of Europe in this moment is the Deutsche Bank. The Deutsche Bank will literally provide to you a loan of 200 millions. So, guys, a lot of money, I will say to you, just for having for being a broker. What they gonna do exactly with the loan? That of course they need to bring back to the bank that they ask the loan. They need to make sure that they are able to at least make 90% of that loan on the first 90 days of the loan that they are getting. Why? Because they will pay less interest on the bank. And how they are doing that one is really, really, really easy. So imagine that at this point you have put on the table 15 million, you have asked a loan of 200 million. I'm talking about good brokerage. Brokerage that they are a good platform all over the place. They have done a lot of marketing, advertising. So they have already 250 million. So for make sure that they will earn the first at least 200 million on the first 90 days of the work, so they can reinvest all the money back to the business, they need to do a specific thing. So which one? Use the 90-90-90 rule. That is really simple. In a way, when you're keeping on the house your trade, the trade of most of the trader that they are losing money, they will gain twice. And usually in 90 days, I have seen the books of some brokerage, they are gain around 90% of the whole loan. 90% of 250 millions, guys, is around 180, 190. So what they are doing after then with all this money, they are paying back the loan, and they are continue to do the business. Guys, my schedule is really tidy. This is just a brief introduction of how this financial work works, and I'm going back to Walter. I'm gonna continue the introduction.
Thank you very much, Giovanni. I appreciate your time. So what did Giovanni just explain? He just explained to you guys exactly how brokers operate. Now, here's why a trap occurs. Number one, a broker would only make money when you're trading. So when you have your money in your trading account and you're not doing anything with the money, brokers gotta make money. So your money can just sit there. You can put in like £5,000 in your broker account, and if you don't trade at all, 6 months later withdraw £5,000. Like, the broker cannot make money unless you're trading. So the first thing is they want to incite the trader to an investor to commit their money in the market. So they want you to make a move because they only make money when you make a move. So a lot of the time, the quick movements that you see in the marketplace that usually takes place around trapping regions is a promise of quick returns. Retail beginner traders, like, they get emotional, they get excited. They're like, wow, I could quickly make this amount. Like, the market is moving really well. This is that candlestick pattern that I read about on Investopedia, or this is that wick that I read about on so and so. So they get excited and they commit to a trade. Now, understand as well that a lot of the time within trapping regions, you would have something that is something called a consolidation, or an accumulation. This is where volume is accumulated within a certain range. So when I say volume, what am I talking about? I'm talking about the amount of people that are buying and selling. All that adds up to volume that accumulates in a range. And that's a good thing. And I'm going to explain why that's a good thing when I show you guys the trading view later on. Now, the next thing we're going to talk about and show you is how to avoid getting trapped. That's the most important thing, right? Because look, don't let what Giovanni said scare you, because look, I'm in love. Like, trading is so fun and exciting when you know what you're doing and when you have the right information. So you need to understand, how can you avoid these traps? Number one, careful analysis. So you need to know how to analyze the market, and you need to analyze it in such a way that you can clearly see where the traps is and know exactly how to avoid it. Number two, you need to have a clear directional bias. So for those of you that were on the training that I did on Sunday, was it Sunday or no, it was on Tuesday. I talked a little bit about directional bias, okay? And I went into detail about how to have a directional bias whenever you're trading. Number three, you need to, I personally use two indicators to help me identify traps and avoid them. So one of them is moving averages, and the second one is a relative strength index, or called RSI, or the composite index, which is something I prefer over the RSI. But RSI is just the simpler basic version. So I'm going to show you guys how to use these things. So number one, how to do a careful analysis. I'm not going to go too much detail about it because I don't want to keep you guys here all night. But I'm going to basically show you guys how to identify traps using moving averages and also relative strength index as well. So what I'm going to do, I'm just going to share my I'm going to share my trading view. Just give me a second. So I'm going to share my trading view with you because I want to show you guys a bit of a breakdown. And please make sure you're taking notes. Like, if you're not taking notes, then you're simply wasting your time, and you're wasting our time as well. Because like, the goal of this training is to really help you guys to really advance. And if you're not taking notes, it's going to be very hard for you to advance. So please do make sure you're taking notes. Okay. Now let me just share my trading view with you. Just give me a second. I'm trying to find it. Okay, so now let's identify some traps with you so you can see exactly what I mean. Okay, so share my desktop with you. Let's go to Pound USD. All right, now, the first thing that you need to understand, of course, remember the three different patterns that I showed you, right, about how traps work. So the first pattern that I showed you was called a wedge, okay? And then the second one is in the horizontal, so it's like, it looks like a consolidation. And then the third way you can identify is also triangles, okay? Now, the first thing I'm gonna show you is exactly what a trapping mechanism looks like. So just give me a second. Let me show you what a trapping mechanism looks like. So I'm gonna go to, one second. I'll first of all find, there you go. Beautiful. Okay, so if we take a look at, just take a look at the bottom here. Okay, just take a look at the bottom. Now, this is an example of a trapping mechanism. Okay, so in this situation, what we saw was price had fallen, right? Price had fallen for a period of time. Now, at this point, a lot of traders are thinking, you know what, I want to sell. Now is the time to sell. So what do? Is they go in for a sell. They open a position to sell anywhere in this region, anticipating price to keep on falling down forever, which it doesn't, of course. Now, for traders that basically love to trade reversals, they will be looking for a sign that price is going to be reversing around this area. So what happens is this. Traders will then commit, would see something like this. So they'll see a 2 bullish candle, and in this position, they're going to commit to going long. I'm going to tell you why, okay? So there's something that's taught called a 3 white soldiers. 3 white soldiers is a bullish pattern. So it's a sign of reversal. So a 3 white soldier is basically when you have 3 candles. So let's say 3 green candles, so 3 bullish candles right next to each other, right? Indicating that price is about to reverse, okay? That's what we call 3 white soldiers. We'll just write that down. So a trader that sees these 2 green candles, they think, oh, maybe there are 3 white soldiers that's copied up. So we've got 2 soldiers, we have the 3rd one. And once we have the 3rd one, that's for sure a sign that price is about to reverse. So what do? They would buy, okay? They'll probably buy on the 3rd soldier because they don't want to miss out on all that volume that's going to come through. But then what happens was this. At that point, a market is now going to slow down. And it slows down for a period of time. It slows down over the Asian session. The next day, it opens just a little bit lower. But do you notice how the moves that the price is moving is not as fast and as big as these ones? The moves are very small. So the person that committed to going long around this area, they're not so scared. They're thinking, okay, maybe this is just a little bit of a drawdown. Now, knowing like the average trading mentality, they would probably do this. They'll probably set an order to go long. I'm going to show you guys. They'll probably set an order to go long around this area, right? And they'll set their take profit, somewhere up there, and they'll set their stop loss just below the 3rd white, the 1st soldier. Now, what's going to happen is this. So they're going to go in there, going to go long, price is going to come up, and it just comes down very slowly. And that's the thing about trapping. Trapping is usually a very slow process. It doesn't happen like super fast, okay? And that's the scary thing about it. It's never like a very fast move. So it's very slow, and all of a sudden they then send price down aggressively, and that stops out the traders. Now that's money that they've taken out of that trader's pocket. And then they send price up in the intended direction anyway. So this is one example of trapping. I'm gonna show you guys another example of trapping, and then I'm gonna hand it over to another EM analyst who's gonna tell you guys how our price is trapped using candlesticks. So another example of trapping, I'm gonna find, actually this took place on Euro USD. Perfect. So Euro USD this week was basically trapping all week. I knew there's a reversal coming, but I was like, you know what? Like they were just holding price in like the same region all through the week. But let me show you how deadly this trap was, because I know for a fact that a lot of traders would have been stuck in this move and would have been forced to hold their position over the weekend. And ladies and gentlemen, like the reason I personally don't hold my position over the weekend is because it costs, number one, it costs money to do so because you're paying swap. And number two, is the most riskiest thing to do when you're trading. I'm going to show you why. Like if you look at Pound USD, for example, right? Price closed right here on a Friday night. So price closed right here on a Friday night. Okay, so this is where price closed. This is like 2 Fridays away. I don't know if you guys remember this trade. This was the trade that was sent out 2 Fridays ago that made us 110 pips. So price kept on falling and it closed at a low. Now, what happened was when markets opened on Sunday night, there was a big gap. Now, that gap is the reason why I really do not like holding positions over the weekend. And sometimes the gap can be in your favor and sometimes it can't be. But the thing is, you cannot anticipate the events that would take place over the weekend that could cause the market to gap, because a lot of political events can happen over the weekend that can cause price to gap. And that's simply why I just never hold over the weekend. It's just far too risky and it's simply not worth it, in my personal opinion. I'd rather close the position and reopen the position when the market opens. So what happened was this, right? So during the week, Euro USD ended in a low, and anyone looking at this and have seen that Euro USD has been falling for 3 days in a row will be thinking, okay, cool. Price is bound to reverse at some point, okay? That's what we're taught, okay? It's like, you know, if you're taught Elliott wave patterns and free wave patterns and ABC patterns and all that kind of stuff, right? You're taught that price usually will trend in a direction for free impulsive movements over the course of 3 days or whatever. And after the 3 or 4 or 5 impulsive movements, you should anticipate a reversal, okay? So around this stage, people are anticipating a reversal to take place. But here's what happened. Over for the whole week, if you notice, price barely moved in any direction for the whole week. Like this is Friday. This is where price closed on Friday. And this is where price opened on Monday, right? So literally, price closed exactly where it opened with no net change in price movement for the entire week. No net change in price movement for the entire week. Now, let's say a trader that was maybe a breakout trader was anticipating a breakout to the top side, and they got in somewhere at the top there, right? And now they're forced to hold their position because they've seen a little bit of a drawdown. And some traders, they don't want to lose money. They're like, I'm going to hold this position because I am so confident that price is going to reverse. So I'm going to hold it for as long as I need to hold it until it goes up. So a trader that got it maybe at the top, and now they're seeing drawdown all throughout Tuesday, and then price begins to come back up. And literally what happens is this, right? When price begins to come back up, the trader that got in there is now excited. They're now excited thinking, okay, now price is coming back up. Maybe I'm going to recover my capital. But then what happens is this, they hold it in the same region. So literally price opened there and closed is in the same place on Thursday. It literally opened and closed in the same place on Thursday. There was no net difference in where price opened and price closed on the same day. And then on Friday, what happened was they spiked price very low. Now at this point, the trader that got in right there, they would either have been stopped out or they would have been scared and they would have closed their position because now they're thinking, I don't want to lose too much money. Or they would have been margin called if they over leveraged their account. So this is the typical trap. A lot of traders would have fallen for this trap, and they would have definitely lost money because what happened was now traders that were thinking, okay, price is falling. So let's say you were looking at price in this area. You're thinking, okay, price is going to keep on falling, and you sold. Now, what would have happened on Friday is if you were in a sell position on Friday, they would have taken back all that money from you, okay? And you would have either been stopped out or you would have closed your position out of fear because of how fast price was moving. Remember, rapid price movements are there to incite fear and to incite emotions in the mind of the investor in any market, not just FX, in stocks, equities, bonds, whatever. So an inexperienced trader would have seen this fast movement and they would have abandoned their short position, either in definitely in a loss, right? It's definitely not going to be in a profit. They would have had to abandon their short position in a loss. So this is a trap. Now, as you can see, in a trap, it doesn't matter what you do, whether you buy or whether you sell, you're still screwed. Because that's why it's called a trap, right? Is there to trap you regardless of what you do? Whether you want to go in a buy or whether you want to sell, like, you're going to be screwed. So I'm going to explain to you guys how you can avoid, like, this is a no trade zone. In this region, you do not trade. You do not commit to a position. This is where we trade, okay? So myself, with Brian, with Giovanni, with Aaron, like, this is our trading region. We trade the dominating moves in the market. We trade always the dominating moves in the market. We avoid trading traps. We avoid going into areas where price isn't going to go anywhere. Okay. Now I'm going to pass you over to another analyst, and this individual is going to cover with you guys candlesticks. As you can see, spikes like these are very, very a huge part of the trapping mechanism. And he's going to explain to you exactly how these spikes work. Even if you look up here, if you guys remember the Euro USD trade from last week, that we had a huge spike that took place in the morning. On I remember this took place early in the hours on Monday, on Thursday morning, right? And then it didn't take us out because I knew where to place the stop loss to avoid it if it did happen. But I did anticipate they might do that. And we had a spike, and then it just came down and took the price away. So he's going to explain to you what these spikes do. What is the purpose of these spikes, and how you can understand them so they don't scare you. Because I remember when I started trading and I would see spikes like these and I got scared and I was like, why? Like, why is this happening? Right? So he's going to explain to you like how to not allow these spikes to scare you, and how you can really identify and understand how they work. So this individual is an analyst also within EM. He's an individual that started trading with us earlier this year. And he is, because of, again, remember what I said, guys, it's not about how much you know, it's about what you know, right? And this individual from day one, he knew, because of him being around us, he knew the right thing to learn. And that's the reason why today he's able to get results within Forex in a short space of time. Myself, him, and Brian and Giovanni, we're right now on the plan to grow our trading accounts to £1 million, you know, by the end of July next year. So, you know, he's definitely someone that I know will also be able to achieve that goal with us. So without any further ado, I just want to bring up Mr. Aaron Chatra to actually share his insights on how these spikes and candlestick patterns are used to track price.
Okay. Walter, can you give me your screen?
Yeah, I can't give you my screen, bro, but I can.
I mean, can you let me have access?
Oh, yeah, sure.
Okay.
I'm going to stop sharing so you can now share.
Okay, let's start this. Okay, we're just going to start from trap areas. All right, CF monkey. Okay, give me 2 seconds. Okay, so before we start on trap areas, I want to discuss trading in general. I mean, you see so many retail traders out there going wrong with whatever they do, how much they learn. If they can learn for years and they can still end up losing all their money. The main way to trade is trading like a bank. When the dealer moves, you move. You don't move before that. You need to understand. I mean, a lot of the time banks go and take out these pending orders. They know where they're placed. They know everything. So they know where the volume is. The one thing I want to discuss in these trap areas is when to take trades after these trap areas occur. And the main place to take these trades is off the high of the day, off the low of the week. You know, like if you get the high of the day, you're banking serious profit, a lot of money. You know, you can hit 5 to 1, you can hit 10 to 1 if you're trading microcycles. You can hit a lot of money. So what I'm just going to discuss to you is the basics of trap areas. But the way we trade, me, Walter, Giovanni, and Brian, is we trade off the high of the day or the low of the day. We catch these moves and we ride it for the whole day. Okay. So go on trap areas. So hammers are the first thing that I want to discuss. Hammers are also seen to be smaller versions of pin bars. So let's talk about hammers. So hammers look to trap volume by pulling price higher than the previous leg. So in here, as you can see, there's an accumulation of orders coming in, and prices ranging until it has enough money to pull out. And what happens here is that the price ranges, and a lot of traders, us retail traders, start to buy in, thinking price is going to go up, but instead it continues to range. Now, a lot of the way these banks make money is is catching these breakout traders. As you can see here, you can see my range, and then you can see how the hammer has been put through. Now, this hammer is not essentially a spike, but it incentivizes or creates a false sentiment of price rising before the dealer pulls back and destroys all of these retail traders that have gone long here. You know, as I've written here, what is a breakout trader? In this case, the breakout trader would break out of the range to the upside, and when price breaks, the breakout traders will pile on in the long positions, and then the dealer will pull out and catch everyone off guard. Now, another thing as well to do that me, Walter, and Giovanni and Brian look at is the news. Okay, the news is an important part of trading. You know, before you turn up to your terminal to trade, you need to look at the news. If you're not looking at the news, then I don't know, like whatever analysis you're doing, it might end up wrong. You know, like if there's red news that comes out, I mean, you can look at Forex Factory, for example, type it in on Google and look it up. Forex Factory has all of the major news releases, and each day I go into the terminal, and before I go and look at my charts, I'll go look at the major news releases, because trading around there in these red news areas is a no-go area. I mean, some people trade of it. I don't trade of it personally. I mean, Giovanni might, because he understands these bank levels. But red news is a no-go for me, and I just carry out my analysis around these areas. If it's orange news or yellow news, then that's fine. Okay, let's move on to the next one. So here, why are they trapping here? So you see a lot of hammers going down. You see I've highlighted below, and it's created this W formation. And after this first leg's been put in, you see price rise. The price doesn't just rise steadily; price accelerates. And what this causes is it causes these traders, these retail traders, to pile on longs before forming another. Actually, I didn't see this here, but another M pattern. So you got W's and M's, so forming an M pattern that drops down, and these people that have piled on long up here. Can I draw on this screen? Pink color. People have piled on long here. If they piled on long here, then the dealers will pull it away, pull it back down, and they'll end on another hammer. But you see here that over here, they're not actually taking out this low. You see, I put the line there, it's flat print. Like at this number here, they haven't. Maybe they spiked it here, but they've blocked this area out. So they've blocked this certain area out, and they said, look, price can go no lower here. We've got all of our orders here, and we're just coming back to collect more orders before we pull back up. And then you can see the way I've counted. So this is on M5 time frame, not M1. So on M5 time frame, you can see the way that I think Brian will explain it later at a later date, or Walter will. But the way price rises, it rises in threes. Okay, you see how it's spiked. This is a pin bar actually. We'll talk about that in a minute. Spiked, and then it's gone 1, 2, and 3. Okay. And then you see more hammers and more hammers here. So there's a lot of trapping that occurs, and I'll talk in detail about a little bit on bank levels, but not too much. I'll just show you on my MT4 in a bit later on. So we're going to pin bars. Now, pin bars are seen as an inducement to create a false sentiment of price going one way before pulling away after collecting all those contracts. I mean, I showed you a bit before what a spike bar is. The spike bar that I said is spike bars here, where they spike it, they create that false sentiment and drop. Create that false sentiment, drop. Okay. Oh, hi, Brian. You got it. Okay. So in my eyes, I'd call it a partial vector candle because of price acceleration and then the pullback fast. So the vector I'm talking about is a candle that has size and acceleration at the same time. So why I call it a partial one is because it's done the vector. I'll show you here. It's done the vector. So price is going rising. Let's say it's going up. Price is rising. It's formed that, but within this time frame, within this candle, prices then dropped. Okay, creating this false sentiment of price rising before pulling back down. Okay. Okay, let me. I don't know how to get rid of this. How do I? It's in my way. Okay, yeah, this is fun. So this was a trade that happened on GU. I don't know if any of you remember it, or Brian and Walter remember it. Is happened on one of these days where GU just kept on rising for 500 pips. You know, like it was relentless. And what I'm talking about is the pin bar is the way that the dealer has gone down and collected all of these orders. It's gone down, collected all those orders, and quickly pulled back up. You know, like this is a candlestick pattern that happens a lot of the time when a lot of traps occur, and they're trapping a lot of volume here. A lot of volume where they think that they know price is going to go up, but they just want to collect all those orders before taking off. Okay, well, like I said before, do not trade red news. It is a no-go. Maybe orange or yellow, I said, but red news is a no-go because you can be caught out very easily unless you know exactly what you're doing. If you trade news, if you know and done your research on it and back tested it, then by all means you can trade it, but it's ill-advised. All right, this is a pin bar. This is a smaller one. I don't think you can see it properly, but because the arrow's in the way. But here we've got a hammer slash pin bar that is just after the range has happened during the accumulation stage. We've seen price keep on going up and down, and then it throws this one key spike. And after that key spike, I mean, it drops. I mean, the risk to reward you can get on this is very high. I mean, it just kept on dropping. I haven't taken in the whole screenshot, but it kept on dropping and dropping. Now, hold on, I don't know how to see this. Give me 2 seconds. Hide video participants. Okay, that's perfect. Okay. So price has been hitting this high constantly all throughout the day, rejecting off it consistently, and then finally it throws that pin, like I said, giving a false sentiment to the traders before dropping price and destroying all the hopes and dreams. Okay. All right, let's move to the next one. Okay, what is an outside structure? Now, the components of an outside structure is vectoring. So this vectoring, what I talked about was a candlestick. I was talking about candlestick pattern. I'll show you here actually. So basically, you see this. You see price rising, vectoring. I'd call that, with the size and the magnitude and acceleration, and rising and throwing a pin. Now, as I said here, ending on a pin or hammer is essential. Okay, more of a pin and a spike, I'd say. A lot of the time, these types of structures can form from news releases or just institutions and banks wanting to pull away from these certain areas after collecting a certain amount of contracts, and they need to take profit quickly. Okay, so going back on here, I was talking about the vectoring. So it vectors up and throws a pin. Now over here, you can see a nice pin rejection thrown here. Now, like I've put on the slide, what's this red box that Aaron's drawn? So this red box is price blocking. As you can see here, after it vectors up, it throws, it comes down and it comes below. So let's see if I get a pen actually. It comes down and it comes below here, and it does not take out this low until it's gone, until it's dropped and collected all of its profits or volume that it needs before moving out. Okay. Now I'm going to show you these on a slide. Another one, okay, oh, I've got another one, I didn't even know that. Okay, I've got another one. Another price blocking area after they've thrown their outside structure, the vectoring and acceleration. Again, it lands on a pin or a spike, so a pin in this case. And then price blocking occurs, and we see how price just moves out and it respects that area so well. Even the next day comes out and respects it. Okay. All right. I'm just going to show you on MT4 a couple of these things, and then I'll pass you back over to Walter or Brian. Okay. But before I get into that, trading in general, remember you only need you only need to know 3 trades to kill the market. Okay. I mean, you can know less than that, but 3 trades, you can do day trading and you can hit a considerable amount of profit if you only know how to do 3 trades. You don't. If you're learning 3 strategies at once, I mean, that's a no-go. You need to learn one strategy and you need to master it. There's no point in learning many strategies and putting them side by side, because you're just your focus is on 3 different things if you're looking at 3. And as well, taking your emotions out of trading is probably one of the most important things. I mean, to think like a computer, think like an EA. That's what we're looking for. I mean, if it follows all of your strategy rules, then take the trade and just sit in it. And I mean, if it hits your stop loss, then that's fine. But if you've done your homework and you found out your strategy is 80%, I mean, who cares if you lose 2 trades if you're winning 8? You know, if you're winning 8 out of 10 and losing 2, I mean, that's amazing. I mean, 80%. Okay, that's amazing. Okay, but that's what we can do here. Okay, so also you need to understand your risk to reward. I mean, you don't want to be getting in a trade where your risk to reward is 1 to 1. Okay, you want to be getting in a trade where it's 1 to 2 or higher. I mean, on an M1 cycle, on M1, 1 to 4 or higher. You know, like it's if we're catching the high of the day, the low of the day, then we're here to bank serious profit. And if you're catching those lows and riding it, I mean, for the rest of your life, you can just wait. I mean, wait for the setup. If your setup takes 3 days to form, wait. You don't want to be coming to a terminal and trading every day. Okay. All right, I'm going to go over it. Oh, blimey, that's a lot. That's a lot of arrows. Okay, so let's go find some outside structures that I was talking about, or pin bars. Okay, here's an outside structure here, as you can see. This is on the hourly chart. You can see prices accumulated here.
Wait, Aaron, I can't see your MT4. I think you just shared you just shared a slide. So if you just unshare it and share the whole screen, then we'll be able to see your trading view. Okay,
how do I do? Hold on. Okay, new share.
Yeah, so share the screen again. So unshare it and share it, but just this time share your whole screen as opposed to specifically the view.
Is that it? Is that fine?
Yep, I can see that now.
Okay, perfect. There we go. Okay, as you can see, price here, as say, this is at the start of the week actually. Price here has accelerated up, created this false sentiment, and threw a massive spike. Okay, now like I said, when we see outside structures, we see a nice vector move up with size and acceleration. God, that's massive, isn't it? Like, how many pips is that? I mean, it's still going up. I mean, it's not okay. That's on my screen now. Okay, so all right, 73 pips. Oh my God, that's insane. I mean, imagine. Okay, that's something you don't want it. You can ride this, but a lot of the time when stuff vectors and accelerates, it's the market I guess you can call it the dealers looking to collect all of these orders and induce all of these traders to go long before pulling away. Okay, and we said that it vectors and it lands on a pin bar, as you can see here again, and it pulls away. Now I'm just going to show you a couple more, and then I'm going to pass you back over. Let's see if we can find some more. Another one. Okay, this might not look like see, outside structures is a concept, so it's going to be different quite a lot of the time. I mean, you can study it, analyze it, and you can understand when and where these will occur. I mean, I heard Giovanni. Well, Giovanni was talking about bank levels. You know, like bank levels. I'm not going to go into too much detail, but our bank levels, they occur at certain points on. Right here, it's occurred at 1.3. This is a lovely bank level. 1.3. Another bank level. 1.29. You know, these are all these lines are key bank levels. So here it's throwing the outside structure, and then I see a pin. You see that pin? Massive pin thrown here, and then it continues. Luckily, it doesn't, as you can see here, it doesn't actually break. It doesn't break your outside structure ever. I mean, it can do. It can go up and break it and come back down within 30 minutes. But that's one of the variations on the theme, okay? So let's see if we can spot some more. Let's go on 15 minutes, actually. God, my MT4 is so laggy. Excuse me. Yeah. Okay. All right, let's see these pins. Oh God, beautiful pin. Amazing pin. And as you can see here, another pin here. We call that a doji, actually. Okay. But here, so the pins, and as you can see, there's trap areas. Why are they throwing pins? Like, where are they throwing them to? So if you understand the structure of your market, so for each pair, you understand the structure of how far these vectors are moving up. How far does it vector on an hour? How far does it vector on a M15? I mean, all of these things need to be noted down for each pair. You need to understand them, and if you're trading 4 pairs, then understand them extensively, research them, understand what your strategy entails, and apply these to your certain currency pairs, and see how they vary on each pair. You know, here, why is this trap occurring here? I mean, as you can see here, there's a 200. I've got moving averages here. This is a 200 moving average. Okay. And over here it's trapped and it's pulled back above. And not just that, you can see here, like here, there's no, I'll place a trap area here. It's trapped. You can see my mouse. You can see a trap area over here to the left, and it's come down. I mean, it's taken out again here, but pulled back up. I mean, in a matter of 15 minutes. And it was like, bye-bye. This is the low of the day. This is 0. I'm pulling out. And look how much it came up, 200 pips. I mean, that's an amazing day if you caught that. I mean, I think around here was where a lot of Brexit news releases were coming out. So I'd say that is very, the market is very choppy and volatile, okay? I mean, I think I showed you enough examples for you to go away and understand. Now, the thing is, writing notes is key. So just to reiterate, you should have been taking notes while I've been talking about this, even just on what hammers are, what are pin bars, what are outside structures. And then I want you to just go away and I want you to find 5 trades, 5 long trades, 5 short trades. And the thing is, if you don't do this, then, I mean, it's nothing off my back. But if you do this, then you're going to gain a lot of knowledge, and you've got to understand. Look, I mean, is that an outside structure or what? Like you've just seen one, like, and you're like, okay. I mean, Aaron taught me that. Let's see if I can put stuff into practice. And you look how to trade off it. Okay. Now, outside structures quite a lot of the time occur at the maybe at the high of the day or the low of the day at the end of the day, and then the next day you can see how price reacts off that. As you can see here, I mean, I won't draw it, but you can see that there's a nice blocked area over here, and price does not exceed that area. All right, I'm going to pass you back over to Walter. Thank you very much, and I hope you have a lovely day.
Thanks a lot, Aaron. That was very, 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 very educational. I appreciate that. Like even seeing how far, and even listening to Aaron now, I was like, wow, like, you know, he's really come so far, and you know, now it's like he's getting results is really not a surprise. Now, one thing I wanted to add on to what Aaron was saying, especially with regards to spike candles, because it's easy to look in the past and to see a spike candle and to think, all right, that's a trap. But a lot of the time, we're not watching price in the past, we're watching price in the present. So what you need to understand is that when you see a spike candle, it's simply painting a picture once the damage has already been done. So the damage has already been done, like the accounts have already either been blown, been closed, whatever, stop loss already been hit. So your spike candle is just painting the picture once the damage has already been done. The skill in trading is really coming to understand, to identify these candles when they're taking place in real time. Because in real time, it's not going to be a spike. In real time, it's going to be a full candle. And it only becomes a spike when price pulls away and closes and a new candle opens. That's when you then identify the spike for what it is. So I'm going to bring on another individual, because another thing to really identifying these candles and identifying the traps is timing. Because there are certain times in the day, there are certain times in the market cycle when these trapping mechanisms do occur, like it occurred last week. And why did it occur last week? Before I should bring on this individual, I'm just going to share with you guys something very, very interesting that I sort of discovered. So one thing I've sort of discovered when it comes to timing is that a lot of the time, trapping tends to take place around the full moon. It's a bit weird, right? I actually have an indicator, a full moon indicator on my screen, and it shows me when the full moon is, right? Because like it's to do with Gann, and I don't know if you guys have ever studied Gann before. That is like one part of Gann's findings that I've taken away, that I've applied to my personal trading strategy, that is actually helping me to identify when these traps are going to be taking place. So last week, we actually had a full moon last week. That could probably explain why, you know, we had that trapping taking place on Euro USD. So yeah, around full moon, you should watch out for the traps. But without any further ado, I want to hand it over to my business partner and someone that has become an incredible trader, and none other than Mr. Brian Lim. So Brian, I'm going to hand it over to you, bro.
Awesome. Thank you for the warm introduction. Can you guys hear my voice? Because I'm in a cafe right now and I'm not sure if it's too loud and I'm not sure if the internet connection's good. So if you guys can hear me clearly, just give me an indication. Yeah, one. Awesome. One is an indication. Fantastic. All right, cool. So what I'm going to be covering is be quite brief, obviously because the call is a little bit longer than anticipated. So the first thing I wanted to cover is basically the timing aspect of a trap, okay? So obviously now we know how traps work, why, like the purpose of it, okay? Now the next step is coming to identify when they are most likely going to occur and the reason for why they do occur at those particular times, okay? So going back to Euro USD, let me just move this to the side somewhere. Let's get rid of this, all right. Okay, so going back to Euro USD last week, okay? So this is Friday, this is Thursday, this is Wednesday, this is Tuesday, and this is Monday, okay? So now let's zoom in, just zoom in on Monday. Now, during the first 8 hours of Monday, okay, this is known as the Asian range. This Asian range is basically in a period called the Dharma period, okay? So during this time, you know, most people are not really actively trading. You know, this is a period where most people in New York, most people in London are asleep. And this is also a period at the time where the dealers will basically collect contracts, okay? So usually during this period, they just go up and down, up and down, up and down, but they don't really go significantly anywhere, okay? So it's important to basically mark out this time period. So what we're gonna do is we're gonna put a horizontal line here at the top of the Asian range, and we're gonna put another horizontal line at the bottom of the Asian range, which is basically around about here, okay? So these two black lines represent the beginning of the week, okay? Now, this is when the London session opens, okay? This is when the people, you know, get to Canary Wharf, which is basically where I am right now, and they get onto the desk and they start putting through orders, okay? Now, one of the most highly probable time where people are looking to trap is basically Monday. Why? It's very, very simple. Because let's say, for example, okay, in this particular scenario, Euro USD, what they did was they did pushes upwards, okay? And as Aaron mentioned and we talked about all the pins and stuff, okay? What they basically did was they grabbed money up there, okay? So now people are in buy positions up here and then they should price down. Now, what's the significance of that, okay? Now, let's just go back to, let's just zoom out a little bit on the 1 hour time frame. Yeah, sorry guys, I'm a little bit ill as well, so if my voice cracks, you know why. Okay, cool. So this was basically last week, right? Where is Monday? Monday's here, okay? So I'm just going to get my crosshairs out. You can see basically price pushed up here. Okay. Now people are stuck in buy positions here. And then when they went down, when they pushed price back down, okay, some people would have lifted their stops, you know, like if you guys have been trading for any period of time, you know, especially if you just started, you guys just generally want to win, right? You guys are in this business for one reason, to make money, you know, no one trades for because it's fun. Okay. People trade because they want to make money. That's as simple as that. Okay. You know, you got to admit it to yourself. So when it comes to losing money, that's something that people also don't want to do, right? So if you put a buy position here and you're biased that, you know, price is definitely going to turn around, price is definitely going to go up, okay? And it starts going up, you see green, 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 and it reverses on you, and now you're in a deficit. You know, you went from seeing plus £20, plus £30 to minus £10, minus £15. You're going to be thinking, oh, you know what? I'm just going to hold on to it for a little bit longer. If it reaches my entry price, you know, then I'm just going to close out and break even, right? That's what most people think they're going to do. But what you think you're going to do and what you actually do is two completely different things, right? What most people do is they'll lift their stops. They'll get rid of their stop loss and they'll just sit in the trade, you know? They'll be like, oh, price is definitely going to come back, you know? It's not going to go much further down. It's not going to go much further down. It's not going to go much further down. And it just keeps going down and keeps going down. So what you've essentially done is you've put yourself in a buy position on Monday, and unless price exceeds your entry price or it hits your take profit, chances are you're just not going to exit the trade, right? So let's say, for the sake of this example, you open a trade right here, okay? You put a buy position right there. Now, price moves down, you're not gonna exit the trade, right? Because you don't want to lose, okay? So next day, price pushes up. You're like, oh, you know what? Price could potentially come back to my entry, and it pushes back down again, and it pushes back down, you know? Now, at the end of the week, obviously, price gets near to your entry point. But you've got to understand one thing. How do brokers make money? Brokers make money in three ways. Number one, spread. Number two, commission. And number three, swap. Okay? When you open a position on Monday and you don't close it overnight, you know, between 9 p.m. to around 11 p.m., the market just goes and, like, you know, price just goes erratic, right? During that period, that's when swap charges are applied, okay? So if you guys have been holding trades for a long period of time, okay, just click on your trade and you'll see that you're paying something called swap, okay? Swap is essentially interest that you have to pay for holding a position. So because they induced you to take a long position right here on Monday, okay, and they've basically forced you to sit through 5 days of chop before it reaches your entry price again, although you haven't lost money on the actual trade itself because you didn't close in a deficit, you're paying them interest just for holding that position. You know, I mean, that's not even to include all the emotional, you know, trauma that you're going to be going through. You're going to be like, oh my God, I was minus £15, now I'm minus 150. You know, obviously it's going to be relative to how much you have in your account, but the chances are, you know, when you're sitting through drawdown like that, you're not going to be thinking sunshines and rainbows. You're going to be thinking, wow, okay, how should I file for bankruptcy? You know, there's something going through the chat box. Awesome, Chris found it funny. Okay, cool. Now, so the primary time you see a trap is obviously Monday. Now, the secondary time where you're going to see another trap is Friday. Now, why is that? Because if you get trapped on Friday, okay, you're forced to hold a position for the next 2 days, Saturday and Sunday. Why are you forced to do that? Well, you can't close your position, can you? Try going to your MT4 right now and try and close the position. I can guarantee you it's not going to work, right? But you're still paying swap, okay? You're still paying swap. You're still sat in drawdown. You know, you're seeing minus £10, minus £15 or whatever. But it doesn't matter what you're seeing. You could be seeing plus £10. You're still paying swap, okay? And that's the point. So if you can see here, okay, let me just go on Friday, okay? You can obviously see that, you know, price made a massive move downwards and then reversed all the way upwards. Now, how did they induce people to take longs? Now, in the retail trading world, okay, there's something known as support and resistance. Okay? Now, let's say, for example, you can't see this last day of data. Let me just hide this. Hold on, let me just get a piece of gum. 1 second. Okay, much better. I can feel my throat again. Okay, I am ready. Okay, let's say you can't see that bit of data, okay? In the retail trading world, there's something known as support and resistance, right? So most people would consider this resistance, okay? Because price is respected multiple times, it's going to drop, okay? And obviously there's something known as support as well, right? So this is support, okay? So price didn't break through here. It broke through here, but I mean, it basically bounced off. Here it bounced off again, okay? Now, Now we established that this black line is support, okay? So we're expecting price to be supported. And you can obviously see here, okay, if you zoom in, right, you can obviously see that there are loads of pin bars here, okay? The pins, just think about it as like some fat, greedy hands grabbing money from below, okay? They're grabbing money from below and you think that they're gonna move upwards, basically, okay? Now it's forming pins, forming pins, forming pins. Now, based off what Aaron taught you, okay, if you just traded this, if you just looked up for the pins and you traded the other direction, you just bought from here, you're gonna get squished, right? You're gonna get squished. Why? Is because they're just gonna throw a massive spike bar down there, 15, 20 pips, you know. Obviously the ADR is not really, really high right now, but if you think about it, this is a 15 pip move. From here to here is a 15 pip move. The ADR, the average daily range, is 30 pips. It moved 50% of its average daily movements in one candle, in 15 minutes, okay? These people that went long here, that bought here because they're seeing pins, they just got destroyed, right? The people that are trading support and resistance, well, they just got destroyed as well, you know? And in 2 hours, they took price all the way back up to this area here. Now, why is this area important? Because as Walter already mentioned, okay, let me zoom out there. As Walter already mentioned, okay, the start of the week, where's the start of the week? Sorry. Yeah, the start of the week is here, as we highlighted using the two black lines, right? The start of the week is here, okay? Then induced you to go long. They made you sit through 1 day, 2 days, 3 days, 4 days, 5 days. They made you sit through a whole 5 days of downward movement before they took price up back to the very same point where the week started. You see these two black lines, all right? So that's the nature of how the market works. You can obviously, like, at the end of the day, what's the point of this market? Okay, the point of this market is very, very simple. It's to mediate the exchange rate between two currencies, right? But at the same time, this is also a business. And like any business, they're here to generate money, okay? Now, who are their clients? Well, their clients are basically retail traders, institutional traders that don't really know what they're doing, people that trade at banks that don't really know what they're doing, right? Those are the people that they're getting money from. This is a zero-sum game. Forex is a zero-sum game. For every winner, there's a loser. For every loser, there is a winner, okay? So every time you lose, you're giving money to them. They're growing their business day by day, okay? So you can see, obviously, right, that price has moved up and down, up and down, up and down. But the rate of exchange, pretty much the same at the end of the week. You know, it started here, finished here, right? Zero-sum game. But during all of this time, this is when they're making their money, okay? This is essentially known as the art of market making. Now, I'm going to show you a couple, 3 more examples. Can you guys see my PowerPoint? Can you guys see my PowerPoint right here? Can you see it zoomed in?
Yeah, I can see it, Brian.
Yeah, awesome. All right. Okay. So as I said, this blue region is the accumulation period, okay? So this is the period of the day where they're accumulating contracts, and then price pushes down, okay? Now, what does this induce people to do? In the retail trading world, okay, there is a type of trading strategy known as a London daybreak strategy, okay? Some of you might be familiar with it. I'm pretty sure Walter used to teach it once upon a time in a land that I'm far, far away. But essentially, how it works. Okay, but essentially the idea behind it is very, very simple. What you're doing is you're putting a buy stop above the Asian range, above this blue box, and you're putting a sell stop below this box, okay? And then your take profit is projected 30 or 40, whatever pips, okay? I don't know, whatever pips you're looking for, okay, in a single trade. So let's say, okay, you use a London daybreak strategy, okay? Put a sell stop down here. Now, they come out and then they hit your stops, okay? They activate your sell stop order, okay? They put you in a little bit of profit, okay? And then 2 candles, they take price all the way back up here. Now you're sitting here at probably minus 10, 15 pips, okay? You're thinking, okay, it's quite close to my stop loss, but maybe I'm just gonna either let it hit my stop or it might go back into profit. I don't really know at this point because most people are clueless. That's a fact. You know, the reason why a lot of people lose is because they're clueless. They think Forex is some sort of way where they can just print money. I mean, you can print money, but you gotta know. Pretty clueless. Okay, price comes back down to the entry. Price comes back down to the entry, and they see a little bit of money. Okay, they see a little bit of money. Now, okay. Now let me do something here. Let me do a little exercise. Where is my annotate button? Annotate, fantastic. Okay. I like black. Black looks good. Okay. Okay. All right, imagine, why is that not dark enough? How do I make it super dark? Does this work? Oh wow, I just drew a box. Fantastic. That's exactly not what I wanted. Okay, fantastic. Okay. Oops. I'm just going to do this again. Okay. Okay. So price moves down. Okay. At this point, you're in a little bit of profit. Okay. Now price moves down a little bit more. Price moves down a little bit more. And what do you think this move is? Most people think this is something known as a retracement, right? Price pulls back and it comes back down to the same region. You're probably thinking, oh, it's going to break this region and it's going to continue going down, right? It's a continuation. What do? Well, they take it back up, you know, and they hold this region, hold it. And then what do they do after that? Once they've induced a lot of people to take short positions down here, okay? So right now, a lot of people are stuck in short positions here. Every time they come down, people are going to be taking short positions because they're getting excited. You know, they're like, oh, price is definitely going to melt. Price is going to crumble. Price is going to get destroyed. You're thinking about your Lamborghinis, your mansions, your villas. And then fast forward another 15 minutes and look what happens. Okay, let me get out the drawing annotate setting. What's wrong with there? Okay. And then you can basically see that price goes all the way up. Okay. So you gotta understand this, guys. For them to move the market in a direction, okay, they must have an incentive to do so. The incentive to do so is to basically make money, right? Just like you're trading in this business to make money, their incentive is also exactly the same, right? So for them to make money, they need you to lose, okay? So because they made you take short positions here, okay, what they're looking to do, okay, is they're looking to push price upwards because your stop loss is going to be up here. It's going to be somewhere around this region. I don't know exactly where your place of stop. It depends on your strategy. Okay, everyone's a different stop loss placement strategy. Okay, but chances are your stop is going to be somewhere up here. And when they shift it like that, when they shift it 50 pips up, you know, either you're going to get stopped out or you're going to lift your stop and you're going to be minus 40%. You hold it for a few more days, minus 50, 60%, minus 70%, and then eventually your account is gone. Either way, the money's going, right? So how do you succeed in this market? If they're manipulating the market in such a way, how is it possible for you to succeed? Well, like with anything, you know, if you want to succeed in anything, you just need to know what you're doing, right? Like, for example, if you want to be a successful engineer, you're not just going to be a successful engineer just by studying, I don't know, biology or something, you know, you'll be the worst engineer in the world. I'm quoting myself, by the way. Anyway, this is another example, okay? Asian range, okay? They break down, okay? And then they pull up, okay? This is a retracement, and then they push back down. People are going short again because they're like, oh yeah, this is a retracement. This is definitely going to crumble, you know? This is going to fall like biological engineering. That's funny. You know, this is going to crumble, They get short. You throw on some fat lot size. On the £1,000 account, you put on like one standard lot because you're super confident. You're going to be like, oh yeah, if I catch 30 pips, I'm going to make £300. You know, make £300. I can go to Malta and have a nice cocktail on the beach. And then your hopes and dreams get destroyed, right? They just push price all the way back up, you know, and they're relentless about it. They have no mercy, you know, and that's the truth. And one last example. It's basically this, okay? It's exactly the same, it's just going in the opposite direction, okay? So obviously the reason why they induced people to take positions up here, okay, why they came up here is because during this accumulation period, there were a lot more sellers than there were buyers, okay? So depending on which side of the range they break out of, it is very, very evident where more of the retail herd is, okay? More people are obviously are selling down here, selling. That's why they push price upwards, because your stop loss is going to be up here, okay? And then once you've been convinced that price is actually going long, they just hit your stops all the way back down. Okay, and if you're sat in here thinking, oh, this is a retracement, and then they start proving you right, you're gonna be like, oh yeah, I'm plus 10 pips again, you know, I am right, and then you're still wrong. Either way, you're always gonna be wrong, you know, and that is what they teach you in most retail strategies. You know, 9 times out of 10, you're gonna be wrong. Don't get me wrong. Using retail systems, you can make money, but where they get you is the fact that most people cannot stay disciplined for long enough. You know, you may have a system that has, let's say, a 75% win rate. It has a 75% win rate, and your risk-reward ratio might be, I don't know, 1 to 3. Okay, and you might be consistent for, let's say, 2-3 weeks. 2-3 months. I don't know, 1-2. But it just takes one slip up, okay? One bit of greed, months your progress is just annihilated in front of your very eyes. So that's why it's very, very important to be consistent as a trader, to be, to have the discipline, to have the psychology under your belt, because it doesn't matter what system you trade. Even if you know exactly what we know, but you have poor trading mentality, you'll never get to where you want to be. That's a fact. It sounds harsh, but that's the truth. So I think that's pretty much all I had to cover today. I'm just going to hand it back over to Walter now, and then we're just going to wrap up here.
Thanks a lot for that, guys. If you really learned something within the past 1 hour of you being on this call, could you just drop a number 5 so that I know that you've not only taken notes, but you've been listening and you've been learning from what we've been sharing with you. So thanks a lot, Brian. I really appreciate your time. I know you're on the way back to Kent right now. All right, so what I'm going to talk about really quick. Brian, can you close your camera, please? Thank you. All right, let's go back on TradingView. So Brian has pretty much showed you everything, like in terms of timing, in terms of when to identify traps. Guys, I really don't want you guys to be scared. Because I know, like I would say, take your hopes and your dreams and annihilate you, and all these kind of strong words can scare the weak-hearted. But that's kind of why myself, Brian, and Giovanni, and Aaron, we fell in love with trading, because we realized that we could be in the position of the market maker. We learned how to basically trade alongside the smart money. So rather than doing trading in this area where a lot of amateur traders would be, we trade where the smart money is, and we just follow the smart money. At the end of the day, that's where there's very little risk when it comes to executing your position and seeing the reward of the position, because it moves really fast. So don't be scared in thinking that, there's no hopes for you guys to not only learn and master this skill set, but to see consistent results from it. There is, like the 100% is, but just don't underestimate the phrase that when people say trading is a skill set, do not underestimate that. Like in any skill, if you're learning a new language, for you to become good at speaking a new language, you need to be really committed to practicing that language on a day-to-day basis for a period of time. You really need to be committed to using that language on a day-to-day basis for a period of time for you to become a master at that language. Trading is exactly the same thing. You don't think you can just become a great trader just by learning a little bit here and there and applying some of the information here and there, and all of a sudden you're gonna wake up in the morning and really know how to trade properly. No, like you gotta be super committed. And that's one of the reasons why we created Elevate Markets, because we wanted to create a community of people that are really passionate about trading, really passionate about learning how to make their money work for them. Because at the end of the day, like we want to surround ourselves with people that are like us. We want to surround ourselves with people that can bring something to the table, that can say, okay, cool, here's what I've discovered. And, that's something that we can add onto our arsenal of tools and knowledge that we can apply to get even better results. And we also want to share all this information with you as well. So what we've done in the month of December, I know you guys have heard about Penthouse Profits. And you guys, I know there's a few people on this call that have been to our previous Penthouse Profit sessions. So what we've done is in the month of December, because a lot of people have been asking us to have another event, another training event, we're going to be having another Elevate Market event in the month of December, okay? And this event isn't going to take place in a penthouse. It's going to be a 2-day training seminar, because we want to share all that we've learned over the past 2 years with you guys. I mean, it's going to be hard to share everything with you in 2 days. But what we've done is we've cut down some of the most useless information, and we've got rid of them. And we just want to share with you guys the most pragmatic information that you need in order to really dominate the market with us in the year of 2020. Now, this seminar is going to be taking place on the 14th of December to the 15th of December. It's going to be for 2 days. We haven't actually publicly announced this yet. We're going to be announcing this on Monday, but we're going to be telling you guys first, because you guys are obviously getting the signals and you're really understanding and serious about trading. So we're going to tell you guys about this first, and we're going to make this public on Monday. So this Forex Impact Seminar is for 2 days, from the 14th to the 15th of December. So on the Friday, it's going to be on a Saturday and a Sunday for the whole weekend. So the purpose of these 2 days is we're going to be sharing everything from the strategy to how to have entries to your risk management to psychology. Like, but these are going to be information that you would not find this anywhere else. Like, you would like search on the internet for some of this stuff and you wouldn't even find anywhere where that can explain to you how this works. Now, these 2 days is only going to be for serious people. Like, we don't want anyone that is thinking about taking training seriously. Like, no, we want to commit and we want to invest our time only with serious people, because the goal for us long term is to expand our group of analysts within Elevate Markets, you know, to have more people who are analyzing the markets together, and we're comparing our analysis together in order to have even much more higher quality trades. So what we're going to provide for you guys is an exclusive 15% discount. For those of you guys that want to be there, please do not share this discount code with anyone. This is only for you guys. It wouldn't be available to the public, right? So just type down the discount code is VIP15. Now, once you have your 15% off, you have your ticket, we're going to send you an email with the location where this event is going to be taking place. So this event location is going to be a secret. Only the people that are committed to being at this event are going to know where this seminar is going to take place. And it will be very intense. I do warn you, it will be very intense. We are going to share a lot of information, but at the same time, it's going to be interactive. There's going to be exercises, there's going to be activities that you would need to do in order to cement what we're going to be teaching you. So guys, you know, that's the website. The website to book your ticket is elevatemarkets.co.uk. The website is now live. We're going to be making this public on Monday to the public. So you guys want to secure your position before anyone else does. Now, that's it for myself. I don't know if Brian wanted to add anything extra about this event, because I know Brian and myself, like, we've really been planning for this, and we've been planning to really make this the most successful event. And we're even planning to feature an incredible trader at this event as well. I'm not going to say too much words about who this trader is going to be, but he's someone that actually owns his own fund, is a fund manager, and you know, he's managing for really big investors. So we actually is going to be coming down and is going to be doing a training on trading psychology. So I'm going to hand it over to Brian. He wants to add a word or two about this event, and then we're going to end this call. So Brian.
Hey guys. Yes, I'm going to keep it quick and simple. So what I want to touch upon was that, yes, the seminar is going to be amazing. I'm not sure if you mentioned the price of it exactly, Walter, but for one ticket, it's £250. And if you want to bring a +1, okay? Now, here's the thing, right? If you bring a +1, you get a discount. But here's the thing, the information that we're sharing is something that, as Walter said, you're not going to find anywhere on the internet. You know, I can guarantee you that. You know, we can literally give you the terms and whatever, and you can Google it all you want. You know, Google's your best friend, whatever you Google. You know, if you're ill, you can find all sorts of information online. But if you Google this, I can guarantee you will not find it online, right? So this information is obviously very, very, how will I say it? It's not for everyone, okay? Only a few people in the world literally know it. And that is why, you know, you shouldn't, if you want to bring a +1, okay? Yes, you get a discount, but this person that you bring with you, you know, you got to make sure that they're actually serious about trading. You got to actually make sure that you're going to, you know, have a solid journey with them, because there's no point bringing your best friend along if he's not interested in Forex. There's no point bringing your best friend along if you know he's not a consistent person, you know. But at the end of the day, it's very, very good in Forex to have an accountability partner. So at the end of the day, you can review your trades together, see where you went, see where you did well, see what you didn't do so well, see what you can improve on, you know, and to give each other constructive feedback. But at the same time, you know, you can't just bring anyone along, right? So what I'd say is, if you choose to bring one person, make sure that that person is serious. You know, make sure that that person is as serious, if not more serious than you are, who's actually committed to changing their lives. Because I'm telling you now, guys, by July 2020, I will turn £1,000 into 1 million over 100 trades. That is something I can guarantee you. I'm gonna have it all over Instagram. I have my second Instagram. It's called My Road to 7 Figures, and you guys can watch it all on there, right? So this seminar, we're going to be hosting multiple ones in future, but this is going to be the first of its kind, and this is going to be the cheapest one, okay? So that's pretty much all I wanted to say. If you guys got any questions, feel free to message myself, Walter, Aaron, or Giovanni, whoever basically told you about this call, okay? On that note, peace out and have a beautiful, beautiful rest of the weekend.
So yeah, thanks a lot for that, Brian. Guys, you know, this has been a great training. The plan is for us to have, so we're actually going to be, in January, we're going to be relaunching Elevate Market VIP, and we're going to be doing like seminars like this, sessions like this, every single week, talking about different parts of the market. And we're also going to have a website where all the videos, like all the recordings of these sessions, will be uploaded onto that website. So guys, this is the beginning of what we believe is going to be something big. You know, the goal is for myself and Brian and Giovanni and Aaron, we want to build an account to £1 million by July next year. We're on track to do that right now, but we don't want to do that on our own. We want to help as many people as possible within Elevate Markets to do the same thing. But again, like we said, it's very important that you're very serious about trading. If you're not serious about trading, it's just not going to work out. But if you're really serious and passionate about really understanding how this marketplace works, then of course, being a part of EM is the right place for you. So on that note, guys, have a wonderful evening. Let me know once you book your ticket, and we'll obviously be sending out the emails on the location at either next week Wednesday or next week Thursday. We're going to be sending out the emails for the location. The spots are very limited. We're actually only looking to accommodate up to 30 people for this training. So it's not going to be a limited amount of people, only 30 people for this training. The reason being is because we don't want to share this information with too many people at this stage. So on that note, guys, have a great evening, and I look forward to speaking to some of you very soon.